Hello and good morning, everyone. Thank you for joining this week's episode of ATRAM's webinar series. Today we'll be touching up on local fixed income as we expound on winners in times of crisis. I am Paolo Edelior, Business Development Manager at ATRAM. As of speaking, volatility persists both in the equities and fixed income space. We want to take you back on how things came to be, as well as provide some outlook to show why it's probably a good idea to come in at current market levels. You can submit questions throughout the discussion by clicking on the Q&A button found on your screens. Additionally, I'd like to let you know that this webinar will be recorded and that copies will be disseminated within the day as well as posted on all our social media pages. Make sure to stay until the end as we will be wrapping up with a quick feedback form. Our speaker this morning is no stranger to our webinars. He's considered as one of the staples and our go-to guy when it comes to bonds. Miguel Liboro is our head of fixed income. He is a 5-time awardee of the Most Astute Investor in Asian Currency Bonds by the Asset Magazine for the years 2015 to 2019. Good morning, Miguel, and welcome back to the show.
Morning, Pao. Thanks for the introduction. I guess you're all looking at the first slide. Could you go to the first slide, guys? Now, I may be giving away the ending of our discussion with this first slide, but before we get into that level of detail, much like Pao just shared something about the environment we're in today, in times of great volatility and uncertainty, it can be useful to take a step back and reassess the landscape, to take a broader view in the hopes of finding some sort of port in the storm, particularly a storm as devastating as the COVID-19 has been. Which appears to have, unfortunately, no immediate end in sight. Panicking is never the right choice, and hopefully after today, we'll be able to give you some clarity on at least one possible investment option, which may help see ourselves and our finances safely through the storm.
Okay, thanks for that, Miguel. I know you're a big movie guy, so right off the bat, I'd like to throw a curveball, so to speak. In your view, what movie can you best assimilate the state of the local fixed income market today and why?
Okay, I just gave a storm analogy, so I'm going to choose something with a storm. It's not a movie, but I'm a huge fan of the show by the History Channel, Vikings. And for anybody that's seen the show, it's great. In order to even get to the new lands, the Vikings have to go through so much uncertainty. They're not exactly sure where they're heading. They have an idea where they want to go. But all they can really kind of do is trust in their conviction to get there, rely on their strategies, and rely on the tools that they have available to them in order to get there. And I think that's very much the situation we're in right now, that we don't know where the end of this kind of pandemic or crisis is. We know where we want to get, and we do have options available to us. So it's a matter of utilizing those options properly. As our CIO likes to say, Phil, stay the course till we get through the other side. So with that, let's begin. Next slide, please. So this chart looks very simple, but the graph in front shows some of the investment options available to us, and this very clearly illustrates the relationship of risk with expected return. Namely, in order to try and generate more attractive levels of return, you need to take more and more investment risk. In today's environment, it can be difficult to commit to taking too much risk. But similarly, we can't be overly cautious and completely shut ourselves to the potential opportunities available. So we'll be focusing our discussion in the middle on stocks and bonds or fixed income, and to a lower point, equities, because these are among the largest financial markets in the world. They're actively traded in global exchanges, and they're also probably the asset classes that most of us have some level of familiarity with. Next slide, please. So in times of crisis, where do you invest? 2020 has not been a kind year thus far to risk markets. You see this very clearly in this essentially tale of two asset classes. Being the riskier asset class, both global and local equities have had a difficult 6 months, 7 months at this point. And while they've since recovered from the lows, they continue to generate broadly negative returns. Fixed income, on the other hand, has continued to gain throughout the same period. A large reason for this is on the slide in front of you. That in this period of heightened volatility, investors flock towards stability. With so much uncertainty around, it's like a port in the storm, going back to our earlier analogy. More specifically though, central banks globally, including our own BSP, have been using monetary policy to help combat economic effects of this pandemic. And cutting interest rates lower to stimulate economic growth has been very positive for those of us invested in fixed income securities. But is this performance in 2020 an outlier? Is fixed income as an asset class only generating these types of gains, despite its generally more stable nature, only because of the pandemic? To help answer this question, it may help to take another step back. Next slide, please. So let's focus on the Philippines. The last 5 years have been reasonably volatile, not even counting 2020. And the graph before us tells a very clear picture, but the numbers in the table tell an even clearer one, I think. Now, for those of you unfamiliar with what the return to risk ratio is, a simplistic way to describe this is how much money are you making based on the actual risk you're taking? Because maybe the market went your way and you made 1%. But if the asset you were invested in had the potential to lose 5% if it went the other way, then that 1% gain you made doesn't suddenly seem like it's worth all that risk, does it? In other words, we try to determine with this metric, among others, whether or not each unit of investment risk taken was efficient in generating an investment return. Now, unsurprisingly, the return to risk ratio is higher for fixed income, the generally less volatile asset class over this period. But maybe a bit more surprisingly is that over the 5-year period, the absolute return of fixed income was higher as well. While a significant contributor of this, of course, was 2020 in the last 7 months, you can see on the graph, even before COVID, that Philippine fixed income was able to deliver a comparable return to equities, even when Philippine equities had good years, but at a considerably lower rate of volatility or risk. And bear in mind that it wasn't just a great 5 years for Philippine fixed income. Back in 2018, we had inflation locally move up to as high as 6.7%. This was a multi-decade high and the worst year for local fixed income that we've seen in a very long time. But even over that period in 2018, the Philippine Fixed Income Index experienced a year-to-date drawdown of just under 5%. Our own total return Peso bond fund strategy was able to keep that drawdown and manage it within less than -1%. I think these numbers illustrate the notion that fixed income is generally a stable asset class, while at the same time disproving the notion that you can't make decent returns while being invested in fixed income. Next slide, please. Now, I think that we've all agreed that there is probably a place for an asset class stable as Philippine fixed income in our portfolios, especially given all the uncertainties of the day. But even within Philippine fixed income, there are a variety of strategies available. Typically, there are 3 major classifications. The first is, as you can see there, tenor slice. These, I think, would be the more commonly, these are among the more common fund strategies available. Usually they're called conservative, defensive, moderate, aggressive, some sort of wording like that. But in the end, what most of these are is essentially tenor slicing strategies to clearly define the risk boundaries. So defensive or short-term funds will only invest in securities up to 3 years. Medium-term funds will only go up to 5, and long-term funds will typically invest in across the curve and longer than 5 years. Now, The second type of strategy is an index strategy. Now, more of us are probably familiar with an index-oriented strategy because of the prevalence of this type of strategy in the Philippine equities market. Similar to the Philippine Equity Index, the Philippine Fixed Income Index is also a market cap weighted strategy. What does this mean? This means that the construction of this index and the strategies that replicate it are largely dependent on what the outstanding securities are in the market. Now, because currently there are far more long-term or long tenor bonds outstanding in the Philippine fixed income market than there are short, an index, the Philippine Fixed Income Index, and so index strategies are typically the equivalent of an 8-year bond. They have an average tenor of 8 years and an average duration or interest rate risk of 6 years. So by definition, investing in a index strategy means that you are essentially giving the view of being very positive on Philippine fixed income, because by definition, you're invested in a very long or higher risk bond fund. And then there's the total return strategy, which I'd like to discuss in a little more detail. Next slide, please. So if you'll allow me to talk about our strategy a little bit, I won't read off the points that you're reading off now on this slide. The fund's aim is to utilize a wide array of techniques, such as those described before you in the slide, in order to not just generate the highest possible return, but the highest possible risk-adjusted return. It means taking the risks really worth taking that have a clear risk-reward proposition and a high probability of success. And it means dialing down the risk when the factors are less clear or the potential rewards not worth the risks. We don't ask our investors to take a view on whether they are positive or negative on fixed income at any point in time and constantly have to worry whether it's time to take profits or add more, but to trust us on making that assessment and allow us to grow their investment when the way is clear or to protect their investment when the risks emerge. The flexibility within the fund strategy allows us to capitalize on tactical trading opportunities, meaning short-term trading opportunities when available, and to aggressively de-risk the portfolio when needed, such as I alluded to earlier, we were able to do in 2018. This is a measure of flexibility that typically tenor sliced or index strategies that have firmer parameters may not possess.
Miguel, thank you for that. At this point, do you mind if I interject? Fixed income typically isn't the easiest asset class to digest, right? Can you take us through the simplest way to understand the process that you go through in your desk?
I don't know if anyone's going to believe that this was unplanned, but your question actually sets us up perfectly for the next slide. So, thanks. How are we able to implement the type of techniques that we described in the previous slide and calibrate our strategy so actively? Because we're always looking. Fundamental analysis is the base of our strategy. This allows us to determine our general view and trend on where interest rates are going. And deep diving into this allows us to identify potential risk events or trigger points, key market events, and gauge overall market sentiment. Give us a good idea of which way the market is leading. We then combine this with technical analysis for the implementation, identifying which portion of the yield curve is poised to benefit the most, which securities are most defensive, most likely to gain in the event that the view is right, which securities are most likely to be actively traded and can give us the liquidity we need to get in or, as the case may be, out of positions once we hit either our profit-taking levels or, if the market goes against us, our risk mitigation or cut loss levels, which securities will allow us to make tactical adjustments with the most seamless integration or effort into the strategy. What are the key levels we should be watching? All this analysis goes into the construction, implementation, execution, and then monitoring of our strategy. We're constantly reviewing and reassessing our views and positioning because as far as we're concerned, not making any adjustment to the portfolio, keeping everything the same as we're doing right now, should be an active decision. Nothing's taken for granted. If something's in the portfolio, it's because we want it there. And the moment we don't want it there, we take it out because it doesn't have a place. Every decision should be an active one, not a passive one. Next slide, please. Financial markets and financial conditions are always changing. As factors shift and new information is introduced, probabilities and outcomes shift as well. Now, I use this slide to illustrate how the fund was positioned on 3 different dates, not very far off from each other, actually. We moved from a very aggressive positioning on April 16, the light blue bar, when there was a clear and immediate risk-reward proposition, to a very conservative positioning on April 30, the blue bar, when it appeared that it was time to take some profits, take some gains off the table, because at that time, the risks didn't seem worth it anymore. And now we're back to a moderately aggressive positioning once more, given the factors at play in this point in time. The points on the right give you some idea of the events occurring and the views we formed on those occasions, prompting us to make these adjustments in the portfolio. The market is constantly shifting, and the total return strategy needs to be able to adjust accordingly. Next slide, please. I've described in some detail the philosophy behind our approach, the methodology behind it, and the rationale for this. Looking back at the last 2 years, which the chart shows, have been a bit volatile and contain a lot of uncertainty. But I believe we can say we've been able to do what we set out to do for our clients, deliver them superior risk-adjusted returns across varying market conditions. Now, that large dip that you see lasted just a month, this March, at the peak of the global sell-off where no market was spared. But as you can see, we recovered quite quickly. And given adjustments we made during that period, we're able to capitalize on the opportunities present amid that uncertainty and volatility. But how do we stack up against the other strategies out there? Next slide, please. Now, this first slide shows our performance compared to long-term or index funds since its inception, since the fund's inception in 2014. Now, some of these funds are the biggest and more well-known in the market, although of course, I've kind of hidden their names. As you can see from this slide, no single fund can claim that it was number 1 the whole time. But you can see from our own performance that we've been quite consistent. Not only are we among the best performing funds in this segment, but we also display decent risk-adjusted return metrics over the period as well. I'd like to take care to highlight specifically that in 2018, of the top performing funds here, majority fared very poorly during the drawdown in that period, whereas we managed to limit the downside very effectively, as you can see from that chart there. For those who are more risk averse, you may be wondering, okay, this is against the more aggressive or index-oriented funds. How do you stack up against the more defensive or conservative funds? Against short-term funds, you see we were able to maintain a comparable risk-to-return profile and manage the drawdown as if we were a short-term fund, even in 2018. But because the strategy has the flexibility to take risks when the opportunity is compelling, we've been able to generate significantly better returns than any conservative or purely defensive fund, while still being able to maintain similar risk profile. Next slide, please. Now, I'd like to leave everyone with just 3 points when considering the ATRAM total return as a bond fund and our strategy. The fund strategy is consistent, systematic, and replicable. What we're doing is not magic. It's, as we like to call it, a mix between art and science. While the fund has only been around for 5 years, we've been implementing the strategy within the firm for over the last 10 years. And I like to think that the team and I have gotten quite adept at it. Our track record, the second point, bears this out. Having been able to navigate through various market conditions with some degree, I believe, of success. And finally, active management. Markets adjust. Our strategies need to be able to adjust as well. Because if your strategy can't adjust to changing conditions, then it's subject to the mercy of the market at all times. You need something that can dial up the risk when the way is clear, or bring it down when there's a lot of roadblocks. Next slide, please. Well, first, I'd like to thank all of you for your time this morning. And going back to our analogy at the beginning, hope that I've shared with you an investment strategy that you can consider a potential port in the storm while we all try to navigate our way through the COVID pandemic. But before I leave you, I'd like to give a quick outlook on Philippine fixed income and why I still believe that now is an excellent time to invest in the fund. So rates are going to be lower for longer. The BSP cut rates from 4% at the end of last year to 2.25% where they are now. They cut the reserve requirement from 14% down to 12%. And in our view, are poised to cut it down another 2% down to 10% by the end of the year. Because of what we believe is fiscal response, which is still being calibrated, we think that a lot of the heavy lifting for now will be done by monetary policy, and they've been able to act accordingly. This is something we don't necessarily expect to change over the medium term. But with rates this low, where's the opportunity going to come from? There's a new 5-year RTD actually still in offer period right now. Based on where this RTD priced, we think it offers a very good opportunity to enter the market. And so for our own strategies, intend to invest quite heavily into it. I'd like to point your attention to the yield curves seen there. The orange yield curve is what the Philippine fixed income yield curve looked like right before the BSP cut policy rates last June 25. Immediately after they did that, interest rates rallied around 60 to 70 basis points lower. Rates have since rebounded off the lows and now present, we feel, a good opportunity to pick up. The fund is certainly taking this opportunity. Because of benign inflation expectations for the balance of the year, with the BSP forecasting 2.3% full year for 2020, we think that certainly over the third quarter, inflation is unlikely to spike higher. And from current levels, once the RTD issues on August 12, we think rates will continue to move gradually lower, continuing to offer upside and gains for those invested in Philippine fixed income. So as I said, despite what's already been a very good year for Philippine fixed income and investors in the fund, we believe there's still upside here. And I would encourage everybody to consider the total return Peso bond fund as an investment avenue during this uncertainty. Thank you.
Thanks for that outlook, Miguel. At this point, I'd like to call on a colleague from our sales team, Pat, to explain us how can we invest in the total return bond fund.
Good morning, everyone. To open an account with ATRAM, you just need to visit our website, www.atram.com.ph. Here you can learn more about all the funds we offer, including the ATRAM Total Return Peso Bond Fund. But if you have more questions, visit our website's Frequently Asked Questions page or the ATRAM Academy page. It will then guide you to our online investment platform, Seedbox. It's as simple as that. I hope you do visit our website, www.atram.com.ph. Thank you.
Thanks, Pat. Miguel, shall we look at the questions from the viewers?
Sure.
Yeah, so first question is, are corporate bonds part of the investment universe for total return?
Yes. Our total return strategy takes into consideration corporate bonds when trying to generate that superior risk-adjusted return. Typically, while we can go to as much as around 25%, historically, we've kept it to around 5 to 10%. An exception for this was actually in 2018. As I've kind of been harping on, 2018 was when inflation moved very high. So with yields at those levels, a lot of very strong names, most notably banks at the time, were issuing 1 to 2 year bonds at over 6 and 7%. Because of that, we took that opportunity to really capitalize and invest heavily for the fund. So During that period, we had just below 20% allocation to corporate bonds. At this point in time, we're back to around 10%.
Thanks for that. I've got a question here. Is it too expensive to buy right now? If we invest in the next week and equities start to recover already in the fourth quarter, then what returns can we get?
Well, as I mentioned in my outlook slide, I do think that it's still a good time to invest in the fund and in the asset class because going back to the point on equities, while from a risk-reward standpoint, of course, given where equities are now, even a partial recovery offers significant upside. You have to think about it from a probabilistic standpoint. Sorry. What's your conviction on an economic recovery happening immediately? Versus what are the chances that the BSP suddenly decides to raise interest rates? So the worst that can happen, I think, realistically, is on the fixed income side, the BSP holds for now, which means that there is no impetus for bond yields to continue moving higher. And in fact, because of where rates are, I feel move gradually lower. The risk, in fact, is to the opposite, I feel. That if the economic recovery is worse than feared, the BSP may act more aggressively than we're expecting, cut rates again sooner than we think, and cause another rally for Philippine fixed income. So from a risk-reward standpoint, it's up to every investor to decide whether or not they want to take the shot at equities or fixed income. But from a probability standpoint, I still believe that fixed income offers the stronger argument.
Thanks for that. A couple more questions here. Why should I invest in the total return bond fund instead of investing in bonds directly?
Well, one thing is the capital outlay required. It typically takes a lot more capital to invest as a retail investor, just simplistically into fixed income. Also, it's not that easy. Although the new RTB being offered via bonds.ph is a huge step in the right direction. Historically, it's been very difficult to invest in fixed income directly. There's no way to do it apart from really going through a bank. There's no way to trade it on your own, really, or there has been no way like going on an online platform. And really, it's having to go through bank intermediaries, going through every step. Apart from being very arduous, there's like fees at every step. Apart from that, it's very difficult to trade it actively on your own because there's no market visibility. You have to literally call each and every counterparty or bank that you want to talk to and ask them whether they have a price for the security when you want to buy it or sell it. So you have all these annoyance factors, but more importantly, you have, I think, a liquidity risk. If you buy a security, for example, you buy just a corporate bond, which are far less liquid than government securities, and for whatever reason, you suddenly need to sell it. What do you do if nobody's willing to buy it? Or at worst, or at best rather, if somebody's only willing to buy it at the cost of a significant discount to you? By investing in a fund will always have that liquidity available. It will ensure that your position is diversified and that you are hopefully not subject to the same type of concentration and price risk that you otherwise would be. Apart from that, there's also the matter of, because we're trading, because we do manage a significant amount of funds and have business relationships with all these counterparties, we typically do get better pricing than you would as an individual.
Thanks for that. How does the fund manage the credit risk given the effect of COVID-19 pandemic to the issuers? What are the criteria of the fund in choosing the corporate bonds, and what sector dominates the fund?
Okay, so in the total return strategy, as I mentioned, first I'll address the allocation within the fund. In the total return strategy, at present we have around 10% in corporate bonds. Of that 10%, the largest portion at this point is probably in the bank bonds. That's around maybe 6% of that 10%. But these are all actually maturing by next year. So from a direct credit standpoint, without even going into each name, we're not very concerned with those. Going into the process, well, we actually have our own in-house proprietary credit review, risk, and analysis process, and it's a very rigorous process. We actually have 14 gradients. And in order for us to be able to consider a issuer worthy of investing, they have to be at least a 9 on that list. So we do have, it may take a little more time for me to kind of discuss it in detail, but we do have an in-house process in place where we screen all these risks. And as I mentioned earlier, we were at 18% and now we're at 10%. And part of the reason for that is because as the pandemic was unfolding, we were actively trimming down that exposure.
Thanks, Miguel. At this point, do you have any final words for our viewers as we will wind down the presentation?
No, just thank you everyone for their time. And again, I'd like to reiterate that I do believe that Philippine fixed income continues to offer a very strong risk-reward proposition.
Thank you, Miguel. I think we can leave it there for this webinar. Thanks also to Pat and to our audience as well for all your questions. If you have any further questions or would like to know more about ATRAM's funds and strategies, please get in touch with your relevant ATRAM relationship manager or visit our new website, www.atram.com.ph. Lastly, please answer the survey at the end of this session as your feedback is valuable to us. We appreciate you taking the time to join us. And on behalf of ATRAM, I would like to wish for the safety of you and your family. Best of luck. Thank you very much and have a great long weekend.